Are you tired of the 9-to-5 lifestyle? Do you want more freedom to do what you want, when you want it, without sacrificing your current income? Then this is the show for you. Every week, we dive into John's journey towards financial freedom and everything he has learned since 2014. Real estate investing, cryptocurrency, stocks, private lending, foreign residency, tax saving strategies, infinite banking, assets protection, and much more. Now, here is your host, the founder of the Wealth and Freedom Nexus, John Rickgarn.
Good morning, afternoon, or evening, depending on where you're listening to this. This is John Rickgarn, your host, as always, of the Wealth and Freedom Nexus podcast. And today we have another threshold or benchmark, if you will, as this is episode number 20. For those of you who have been listening from the beginning, thanks for joining in again. And if this is your first time joining us, be sure to hit that subscribe button so you never miss an episode. Now, with today's guest, we're actually talking on so many things. We had to break this up into two segments. So again, be sure to subscribe so you hit both of those. But today, one of the questions I get most often, both as an investor and a real estate agent, is how do I qualify for a mortgage loan, specifically for an investment property? Now, fortunately / unfortunately, depending on where you sit on this, the days of, no money down, 110% loan to value, negative amortization, no job, no income, fog a mirror, you're applied. Those days are long gone. So unfortunately, you need to bring a little bit more to the table now. With that, I have a guest, Caeli Ridge, who is the president of Ridge Lending Group. As you can probably tell from the name, does lending specifically for investors and is more of an investor-friendly lending institution. And on top of that, Caeli as well is a real estate investor. So she not only helps real estate investors, she is one herself. So with that, Caeli, welcome to the show.
Thank you so much, John. Hello, Freedom Nexus listeners. I'm very happy to be here. I'm only gonna, if you want to go over this, John, we can. It's pronounced Caeli.
Caeli, sorry.
That's okay. That's okay. You will not be the first or the last that's going to get that one wrong. So for anybody out there that's watching or listening, it's spelled Caeli. Therein lies the lifelong confusion to my name. It is pronounced Caeli, like Haley with the C. So I tell people the association is Haley's Comet. Just put a C in front of Haley and you got it.
Gotcha. That's an easy way to remember it. So Caeli Ridge is joining us then. So.
Yes, sir. Yeah, very happy to be here. Hopefully I'm able to impart some good value to your listeners. I'm ready to get going. I think maybe just to start, I'll give everybody a quick background on myself.
Absolutely.
Okay, high level stuff. So Ridge Lending Group is a second generation company. We do focus a lot of our attention in the non-owner occupied or investment property space, while fully functional in everything, VA, FHA, owner occupied, all of that. We really have carved out a name for the investor and what those lending needs are. We are licensed nationwide. So we have a nice broad footprint. There's only 4 states that we are not in. Those are Alaska, North Dakota, New York, and Vermont. Otherwise, we're everywhere. I've been in this space and working with investors for just under 25 years now, but I think that, and you had mentioned this, John, I think what's rather unique about us, really me, is that I am a fellow real estate investor. I've held many, many properties all over the United States. So I think the hope is that having worn both hats and being able to look at it from the different lenses, investor and lender focusing on investors, adds some credibility to who we are and what we do. I think the primary value add that we tout in the marketplace is education. And that goes back to my vantage point, right? Being an investor and being a lender that focuses on investors, the education that I'm able to impart to our clients, I think is invaluable. I think everybody agrees that the learning curve in real estate investing, just on its own merit, just by itself, hugely intense. So many moving parts, so much to learn, so much to know. I'm always quoted as saying, when we start to add in and pile on all of the financing on top of that, it exponentially increases that learning curve. And for most people that I talk to, they confess that it's the finance that they get a little bit tweaky about. It can be overwhelming. But, right, it is the leverage and the use of other people's money that's going to give us the greatest ROI or rate of return on that investment. So it seems obvious that we want to have some basis of information, right? Some definitions, what's going on under the hood of the underwriting guidelines. How does that apply to me and my qualifications and my goals today and next week and next month and next year? Take all of that, jumble it up. And really what the purpose is for us in that education piece is to teach the individual how to optimize those qualifications.
Okay.
Right? Because as an investor, our debt to income ratio, our credit and our asset are not a static thing. It doesn't just go like this. We're buying and selling and refinancing and all of these things. So the qualifications are going to be inherently fluid. It's very important to be working with a lender that can advise you, has their finger on the pulse as things change, and can teach you how to keep those qualifications at their best, right? How do you read a Schedule E? How do you keep credit score high? All these things are what we do our very best to impart to our clients. And then finally, I would say another real value add for us is that we are not a one size fits all. We don't just have one product or this size box that you have to fit into.
Sure.
We have a very diverse menu, quite a few, and I think we'll probably get into some of that in more detail, but quite a few loan products that we have, many of which are very specifically tailored to the real estate investor. So, yeah, we're pretty great.
All right. Sounds good. Well, yeah, definitely appreciate that. And I can attest to, I've worked with many lenders over the years, and some are very much in a, tight little box, if you will. And some flat out just say, we work with homeowners and that's it. We don't do anything with investment properties. So,
right. Since you said, I'm sorry to interrupt, John. I should have probably mentioned too, because this kind of adds into not being a one size fits all, but we are not also the lender that's going to say, okay, you don't qualify today, see you later. We're going to look at it from a holistic perspective and say, okay, this is where you are. This is what we can do for you today. Because I can guarantee you we have a loan product that will fit any scenario. Now, whether or not the individual wants those rates and terms is another story. And if they don't, then we start, creating the roadmap to get them to qualify. Here's the steps that need to be taken. So it really is investor friendly and building that culture and relationship for the long term.
Okay. Sounds good. I'll just kind of speak in a little, maybe hypotheticals, if you will, of say, Mr. and Mrs. Lender are listening to this and they are wanting to get into real estate investing. Maybe they already have one of their, slots, so to speak, with their primary residence. And maybe they're wanting to look at, investment property with, Freedom Real Estate Group in Ohio, or Build to Rent in Florida, for instance, which we've had in the show before as well. Maybe just taking a step back, can you talk to what are called the 10 golden tickets in the industry? And maybe just a better question, why is there the cutoff of 10?
Yeah. So the golden tickets, quickly to define, we call these golden tickets. I may have coined this, by the way. I'm not sure. I'm not going to put money on it, but I think I might have, because I've been saying this for a long, long time. This is what we call the Fannie Mae, Freddie Mac loans. These are the agency loans, the conventional loans. We call them the golden tickets because it's the highest leverage at the lowest interest rate, literally on the planet. So hence the name golden tickets. One of the first pieces of advice that we give to our clients when they come in, and this is part of the education, is that if I have a husband and wife team, Mr. and Mrs. Lender, the first thing I'm going to do is say, we want to look at you two individually, right? So in terms of qualifying, if we go joint on an application, that's 10. If we split you up, now we've got access to 20 potential golden tickets. Whether or not they think they're going to use that many is really irrelevant to me. I think having access to that, should they need it down the road, is most important. And if one can qualify now and the other one can't, then we work to maybe get them to qualify should they need them later on. They can always be joint on title, right? As long as the debt obligation is separate, they can optimize how many golden tickets that they have. To your question, though, about why is it only 10? So many may remember, many not, 0809, right? The giant housing and lending crash of 0809. Very quickly thereafter, the unlimited number of conventional loans or financed investment properties you could get, unlimited, right? I mean, we had clients that had 200 properties and we were still doing loans for them, right? So there really wasn't a limit then. As long as you qualified, there, you had your down payment, et cetera, you could get those loans. So fast forward, 0809, almost immediately. It was like a light switch. You went from unlimited and they jacked us down to 4.
Wow.
4 max conventional loans. And at the time, there, all the other lenders, the Lehman and the everybody, the implodometer, we had this thing called the implodometer, the lender implodometer, and they were going down daily.
Yeah.
So we didn't have other options to offer. So we went from unlimited access and resources for finance to 4 anywhere for anything. It was it was a tough time for a lender that focused on investment and an investor. It ended up working out, I think, to everybody's advantage, and maybe we get into that. So it went from unlimited to 4, and then after a few years, it went to 6, and it has been capped at 10 for, the last 6 or 7. There's been talk for many years that they may be increasing. Fannie Freddie may be adding to that 12, maybe 15. As many times as I've heard it, I expect it to maybe happen between now and my death. I'm not sure.
Sure.
But beyond that, we have a whole variety of other products that in like kind, still 30-year fixed, similar in many ways to what the 30 is. And there is no limit on those.
Okay. All right. Good to know. Yeah. For any listeners out there, if you've, maybe didn't live through the time or don't remember the times of the Great Recession, I highly recommend the movie The Big Short. I think that kind of gave a bird's eye view of just how, shall we say, detrimental some of the banking players got during that time, but we won't go down that rabbit hole during this podcast. So now, Caeli, so we've obviously had unlimited. Now went to 4. Now we're at 10, potentially 20. If, say it's a husband and wife filing taxes jointly, and maybe they can qualify individually, but just kind of right out the gate, say, an investor has come across, I'll just pull up an actual number. There was a property for $130,000 and monthly rents are $1,250 a month. And this is going to be their first investment property. So what are the, hoops or what are the qualifications needed to qualify for their first investment property loan?
So the 3 primary, I touched on those earlier, the 3 primary criteria. There's lots that goes into underwriting a loan, and in particular an investment property loan. But the 3 things that we're really going to focus on are going to be the debt to income ratio, the credit score, and the assets. Okay, so we'll take those one at a time. I'm going to save DTI for the end. Okay. Credit score, of the 10 golden tickets, it's important to maybe preface by saying there's 2 or 3 very distinct underwriting books, let's call them, in the conventional space. Depending on how many finance properties you have, a new set of guidelines will apply. So for credit, there's 2 books. The first book applies to the loans that fall in 1 through 6. And then there's a second set of guidelines, or a new set of guidelines, that we'll adhere to for 7, 8, 9, and 10. Okay. So if this is their first investment property and maybe they have a primary, they're well within the first book. And for credit, the guideline says that there isn't a hard and fast. We've had clients that have a 650 credit score. We're able to get them approved because they have compensating factors, low debt to income, high assets, et cetera. So really there's not going to be a baseline. Now, what happens is that when we move to the 7 through 10, they raise the qualification bar. There is a hard and fast minimum middle credit score. So everybody's usually got 3 credit scores: Equifax, TransUnion, Experian. Most people know those names. We're going to take the middle of those 3. Okay. We must have a 720 or greater to get any kind of investment property loan in a 7 through 10 of the 10 conventional loan limit. Okay. So that's the first thing. Now, assets, a little bit different. There's let's call 3 boxes. Okay. The first is 1 through 4 financed. There's a second book of guidelines for the 5th and 6th. Okay. And then the final book of underwriting guidelines is going to be through the 7th through 10th. Okay. And basically, and I have a visual aid for this, John. So if you want, I can send it to you and you can make it available to your listeners. I'm going to go over it quickly, and it's a little bit complicated. So if anybody wants this to kind of see it in black and white, by all means, it's easily available. The way in which the reserve requirement, which is in addition to your down payment for a purchase, right? You've got your 20% down or your 25% down, whatever. The reserve requirement, first of all, can be in non-liquid, like your retirement accounts, or liquid form. Either of those work. It's going to be calculated based on the unpaid principal balance of the rental properties times a percentage. And the percentage will be 2, 4, or 6%, correlating to 1 through 4, 5 and 6, 7 through 10. So
Okay.
2% on unpaid principal balance, rental property, mortgage, unpaid principal balance in 1 through 4, 2%, 4%, 6%, right?
Okay.
Hopefully they can follow that. Now that's in addition to, we're going to take whatever that calculation ends up being, and we're going to add it to 6 months worth of our subject properties PITI, principal, interest, taxes and insurance monthly, and HOA if it applies.
Okay.
So if it's helpful, should I go through an example, do you think?
Sure. Yeah. Maybe just a quick and dirty, or maybe a simple example.
Well, this is the one that I usually use, and I take it all the way up to the 10th property, right? Because this is kind of the worst case scenario,
Sure.
or right on the higher end of what it would be. So let's say that Mr. and Mrs. Lender, Mr. Lender is purchasing his 10th investment property, and that property has a principal and interest, tax and insurance payment of $1,000 a month.
Okay.
We know that's our subject property, so that's going to be 1,000 times 6 months.
Okay.
6 months PIT of the subject. There's $6,000. Now, properties number 2 through 9 are our rental properties, because while I do not have to include a primary residence unpaid principal balance, it still counts as the number of finance properties.
Okay.
Okay. So property number 1 is the primary.
Okay.
Properties number 2 through 9 are the other rentals. And for easy math, we're going to say that each one of those has an unpaid principal balance of $100,000 each.
Okay.
So we have $800,000 of unpaid principal balance, right?
Mm-hmm.
Now we're in the 6% bucket. So 800,000 times 6% is 48,000.
Okay.
Plus $6,000 for my subject property. We would be at $54,000 of reserves required in that example.
Okay.
I should maybe mention that for the down payment, right, they're 20% down or whatever it ends up being, those funds need to be in liquid form, and they need to be sourced and seasoned. And quickly, sourced and seasoned just means that the bank statements or the asset statements that the individual has sent us, if there is a large deposit, which is defined by anything over 50% of their income.
Okay.
So if they made $10,000 a month and there's a deposit for $5,000, I will question it. As long as I can prove via paper trail that it originated with them, it's perfectly acceptable.
Okay.
If Great Aunt Alice said, here you go, John, here's $5,000, go on a trip, I cannot let you use that $5,000 in an asset for your down payment until it is sat in there a full 60 days to where I don't see the deposit anymore.
Okay.
I only see the balance. Okay,
Gotcha.
That's sourced and seasoned. 60
Gotcha.
days, sourced and seasoned. If I see a large deposit and I can show it started with you, fine. If I can't, you got to let it sit there for the full 60.
Okay.
Assets, we got the reserves, the down payment has to be liquid. I think that handles assets. Let's talk about debt to income ratio, because this one is the one that I think that a lot of people will tend to get tripped up over. And I think this is really more to your point and what that question was, right?
Sure.
I think what you really want to know is how much of the income of this new investment that's going to yield a liability monthly, but also income, how is that going to work to our advantage perhaps, right? That's really what I think we want to spend the most time talking about. So let's start by informing everybody. Conventionally, there's 2 ways in which we will quantify or calculate rental income for residential real estate.
Okay.
The first way is called the acquisition year, and the second way is called the Schedule E.
Okay.
I'm going to hold off on getting too far into the Schedule E formula because it's far too complicated without lots of visual aids and things.
Okay.
And for our purposes right now, I think we really just want to find out what happens when I'm purchasing this property. How much of that income, if any, do I get to use?
Sure.
Okay. So it first starts with, what is your primary housing expense? Okay. If you live rent-free, for example, you don't pay rent and you don't have a mortgage, you live rent-free, 0 of the proposed gross monthly income from this property can be given to that individual. You have to be able to qualify with the whole entire new mortgage payment. Now, if you're a renter or a homeowner, but you have 0 experience with real estate and rental properties, I can give you up to a maximum of 75% of the gross rents to offset the mortgage payment.
Okay.
The formula is this, and I'm going to come back to that in a second. The baseline formula is this: 75% of the gross rents minus the proposed PITI, principal, interest, tax, and insurance. As an easy math example, let's say our gross rents are 1,000, and let's say our PITI is 500.
Okay.
The maximum anyone's going to get would be 75% of 1,000. So I have $750 of income. And from that, I'm going to take away $500 a month of the PITI.
Okay.
In that example, I'm left with a $250 gain, right?
Yep.
Okay. Depending on the following commentary, the individual will get to keep that gain or just offset the 500.
Okay.
So if you have a primary housing expense and you do not have any rental property history, right? You haven't owned a rental property. This is the first time that you've done it. I can only offset.
Okay.
So that's 750. The maximum in that person's case they get is really 500 to offset the PITI. If you have history as a landlord or a real estate investor, then you get to have the gain.
Okay.
Okay. So it gets a little bit tripped up and tricky there, but those are important details for one to understand. If they need that extra, in my example, 250 gain to qualify, they need to understand that one, they have to have a primary housing expense, and two, they're going to have to show 12-month history of being an investor.
Okay. And then 12-month history, that would be through the schedulees or usually from their primary or previous tax year returns?
Usually, or depending on where we find ourselves in any calendar year, maybe they haven't filed the last year's tax return yet.
Okay.
Right? Maybe it's on extension. And if I can show that they purchased a property 12 months ago and I show the final closing disclosure, that gives me a year right there.
Okay.
Usually the scheduling, but not always.
Okay. Sounds good. All right. So definitely a lot to unpack there. And I'm just going to kind of pick a few things that I gathered from that. So you had mentioned obviously the reserves, and I believe the unpaid principal balance, that's fairly new because I think it used to be kind of always 6 months PITI for properties, 2, 3, 4, et cetera. But now it's kind of shifted more to the unpaid principal balance.
You're right. It used to be, and there would be an equation there. You would take 6 months on however many properties, and then depending on how many they had, it would go up from there. But the percentage of unpaid principal balance has been around for quite a few years.
Oh, okay. Gotcha.
It's not super new. I would say 3-4 years.
Gotcha.
Maybe.
Okay. Yeah. And I first started researching in a real estate investment almost 8 years ago. So I've just always used the 6 months myself for a quick down and dirty math.
It's probably close, John. I mean, it's probably within a few $1,000s max.
Sure.
Right. If you stop and do the math. The formula that I just gave, the unpaid principal balance, is slightly different from Fannie to Freddie. This one should be the more conservative and actually come up with a slightly higher in reserve. So that's the one that we just educate our clients with.
Okay. And now you had mentioned the reserves for this. This could be, liquid or non-liquid. So if I'm just throwing out some examples like a Roth IRA balance, 401k balance, cash value in a life insurance. What about like if someone has like a HELOC balance that's available?
I love that you brought this up. So all of those are applicable. HELOC, absolutely. HELOC is liquid actually for our purposes. So those would absolutely apply if they had it available. But one thing that is important to mention to the listeners is that if it's a non-liquid account, right? If it's one of your retirement accounts, you will ask for the terms of withdrawal. Let's use a 401k. It's a pretty common one. Okay. And let's say you have $100,000 in your 401k. Okay. But you have a $5,000 loan out against that $100,000. Well, your terms of withdrawal, when we get them, tell us that you can only have one loan at a time. That's part of the terms. So in that example, we would not be able to look at the other $95,000 at all for the reserve requirement until that $5,000 was paid off. Right. So terms of withdrawal will be important. You make sure that you look at your terms of withdrawal. Normally it's not an issue, but if it says that it's not available based on X, Y, or Z, you can't use it. Okay.
And I'm just thinking out loud here, this is probably one of the many nuances, if you want to call it, where having an experienced lender, by your side to help you is, I know some have, I don't want to say enforce or encourage, but many people have taken out a loan for rental property and they just like, oh, I can take out $50,000 for my 401k. Well, if you already have a loan, but maybe you have, $500,000 in your 401k and you say, oh, I can use this for my reserves. Well, taking out that loan, that could potentially maybe just, get to the point where you're not qualified for the loan, even though you technically have a $500,000 401k balance.
Right. It could be counterintuitive to what you're trying to do. So just make sure that you look at your terms of withdrawal and you know what it says. And sometimes it might say you can have 2 loans at a time. I mean, everybody's is going to be a little bit different. So something to think about.
Okay. And then I'm guessing we've highlighted self-directed retirement accounts on this show a couple of times. I'm assuming Roth IRAs, traditional IRAs are a little bit more, shall we say, lenient, because obviously you can't take a loan out of an IRA like you can a 401k.
I don't usually see any restriction in the terms of those assets. It's pretty uncommon. And since you talked about it, it may be useful to, now I don't, again, rabbit holes, right?
Sure.
A self-directed IRA, you can actually use as income, depending on your age and some other factors. If you're not able to show enough ordinary income on a W-2 or a tax return, et cetera, we are able to look at the asset in a self-directed IRA, calculate what we're short in income. They would have to take a regular distribution, at least for the time that we would be getting the loan closed, and they could stop it after that. But there are ways in which they can qualify using that asset as income for the interim of the loan.
Okay, good to know.
Conventionally, yeah.
All right. And now you had mentioned kind of maybe the sticky points sometimes for the debt to income ratio, which, quick and dirty math, couple makes $10,000 a month and they have, $3,300 a month between their mortgage, their student loans, their minimum credit card payments, et cetera. So, 3,300 divided by 10,000. If my math is right, I think that's 33% for a DTI. Is 50% still the absolute cap that no one will lend on, or has that changed as well?
That is correct. 50% on a non-owner occupied conventionally is really going to be the threshold. If it's an owner occupied, I've seen with compensating factors that can exceed that 50% depending on circumstances, but hard and fast, 50% on non-owner occupied.
Okay. And then now that is as I understand, that's the Freddie Mae guidelines, but now some banks, won't name names, but kind of the big ones where they, shy away from investor loans, while conventionally they may allow a 50% DTI. They may have their own internal books that say, well, we can allow this, but we only go up to 39%, for instance.
Yeah, that's called an overlay. So this is common in our industry. So we start with what's called a seller's guide. A seller's guide is about a 1,400-page document that with ridiculous detail defines for us exactly what has to happen for any Fannie Freddie loan product for it to be sold and insured by the United States federal government. Okay. So Ridge is going to go straight by the seller's guide.
Okay.
Any kind of layering of risk, the one that you mentioned is that let's say that one of the big boy banks for a non-owner occupied caps you at 39%, even though the seller's guide guideline says we can go to 50, that's an overlay. Or let's say that we can have 10, right? Fannie Freddie says you can have 10, but another big boy bank over here says, no, we're only going to do 4. That's an example of an overlay.
Okay. Yeah, sounds good. And now you've kind of mentioned income, and I know a lot of people just are like, well, duh, income is income. Now, if you have just a, normal W-2 job where you can say, hey, Caeli, here's my last 2 pay stubs. Here's my W-2. I've been at this job at, FedEx for the last 6, 7, 8 years. I'm guessing that's pretty self-explanatory. But as far as, say, I'll just pick on myself. I have 1099 income. I have dividend income. I'm self-employed. I have commissions. I have short-term rental income and long-term rental income. Are all those factored in the same way, or are there a little bit differing guides as far as how those are counted?
One of the things that's consistent about that, everything that you mentioned, and maybe even a few more. So commission, bonus, dividend, anything like that, we're going to want to see a 2-year history of it. And we're going to take a 24-month average of that type of income. Okay. So the other thing to remember about that is that generally speaking, and this kind of goes outside of that a little bit, on a self-employed basis, right, just self-employed income, it depends on how you're claiming your deductions. There's certain things that we can add back for, et cetera. Generally speaking, we're going to take a 24-month average of a self-employed adjusted gross, adding and subtracting certain things depending on what those might be, unless the most recent year filed is in a decline status, which means that if in 2020 I made $100,000, but in 2021 I show that I made $95,000. That's technically in a decline. They're not going to give us a 24-month average, which would be to our advantage. They're going to give us a 12-month average on the 95. Gotcha. They tend to get super conservative. There's another piece of that I was gonna outline or detail. If you've been self-employed, here's another kind of cool thing. If you've been self-employed, and we can show that for 5 years, oftentimes, if it's to your advantage, we only need 1 year worth of
Oh, okay.
tax return or income. We don't need the 2 years. So if under the precipice that the year prior was lower and the most recent is higher, putting those together and dividing would probably drive it down.
Sure.
If you have 5 years of self-employed, then we will take the most recent year. We don't need to average the two. So there might be some advantage to that.
Okay. So long and short, if you're self-employed, try to make more money every year or keep it the exact same year after year.
Right. And, let me add to this. So there's a lot of moving parts. We've already established that. When it comes to the income and the debt to income ratio, it really is this kind of ominous thing, depending on what your circumstances are, exceptions to every rule. But when we find ourselves in a unique place at the end of a prior year, at the beginning of a new year, we often will work with our clients and look at their draft tax returns. If qualifying this year is very, very important to them for whatever those reasons are, we can get our hands on a draft return the way that they would file it normally, take it, plug it into the formula, the worksheets that Fannie Freddie use, get a spit out number. What is the number going to be? Is it going to be this much of a gain, this much of a loss, whatever it is? And then we can work it backwards with them and say, okay, listen, if you really want to qualify this year, you're going to have to back off on some of these deductions because your DTI is not going to support it. Now, whether they want to do that is up to them, but at least they'll have the information to make that informed decision. Usually it means you're going to pay a little bit more in taxes. Probably it's usually one or the other.
Sure. Yeah.
Qualify, pay more in taxes. And sometimes we find that, they'll get really, really lean on the deductions in this year, qualify, and then the next year they take all the deductions because they're not going to do anything. So they will sequence it appropriately in the strategy of when they're going to do what. So anyway, I thought it was worth a mention. No,
I appreciate that. So so yeah, we've obviously gone over the DTI 50%, hard stop, liquid or non-liquid funds for the reserves, 60 days source and season for a down payment, whether that's from great Aunt Sally or someone just became a millionaire from crypto holdings. I don't know. Maybe there's all sorts of avenues that those funds can come through. Now, if someone could qualify, and I'm just going to maybe just say an example, say a married couple, and they are able to qualify for, up to 20 Freddie Fannie slots with the, at the time of this recording, I think rates are at the, 3.5%, 4% for 30-year fixed, give or take. Now, I'm just kind of throwing out some, ideas here, but if say both spouses, they make $50,000 a year, is that pretty much beneficial? Or if there's an instance where maybe the, wife is stay at home or maybe just works part-time, but the husband is, high earner sales job, would that be an instance that they may not qualify individually?
Whenever we can get them to qualify individually, that's what we're going to advise. And we will look for ways in which to accomplish that. If at the end of the day, it makes more sense to go forward with the investment for all these reasons, then we'll chew up a loan spot and get them both on that loan if we need both incomes. More often than not, that doesn't seem to be the case. There's usually one that we can go forward with. Because remember, unless they live rent-free, we're offsetting that new mortgage payment.
Sure.
Right? Worst case scenario. So there's no new debt being added to the debt to income ratio. So the income that they have when they start satisfies the monthly liabilities on that credit report. And I say that with kind of a pointed tone because a lot of people think that ordinary living expenses go into that 50% debt to income ratio.
Right.
And they do not, right? Cell phone bills, gas, food, utilities, none of that plays a role. It's the minimum payment on that credit report only that we're going to be monthly, that we're going to be dividing into the monthly debt. And that's how we're going to factor it. So did I answer the question on that, John?
Yeah, no. And you actually brought up one thing I was just thinking, because my wife and I ran into this a couple of years ago. And now, as I understand it, if you are, trying to qualify individually, if there is, say, joint income, say from a rental property or, I don't know, some kind of income that is coming into both of those, then only half of that income can be counted. But if it's like a joint debt, say their mortgage, that's the primary residence, that's in both of their names, even though that's in to both of them, that entire mortgage amount has to be counted as well, which can possibly offset a little. Is that correct still?
So the second part is correct. If you're on a loan and you have signed it as you're you've obligated yourself to that debt, it doesn't matter that the two of you are on there. If, for example, she doesn't make her half or you don't make your half, it doesn't matter to the bank. You're still 100% obligated. They're getting paid. So they're going to hit you for the full debt, whether or not it's a joint application. The income, however, you should be getting 100% of that. If someone told you that they're cutting that in half, they shouldn't get it both ways.
Oh, okay.
Yeah, you should get all of the income on it.
Oh, interesting. Yeah, I actually won't name names, and I actually can't because the bank that I ran into this got bought out by another bank and then merged with another bank. So who knows where they're at now? So, okay, good to know.
Now,
all right.
Let me go back one thing. So this came up recently. Two brothers purchased this property together. They are both on the loan and they both filed the tax return, their individual tax returns with those properties on. He claims 50% of income. He claims 50% of income. In that example, I was able to cut because it's clearly how they're doing it. We could have done it either way. I could have either given him 100% of the income and hit him for the 100% of the debt, or give him only 50% or 50% of the debt because he only claimed 50% of the income. So 6 to 1. They can't have it both ways, right? The lender is strict enough. They have to choose and pick a lane and stay there.
Okay, gotcha.
Yeah.
Good to know. Well, as we're getting towards the end of this podcast, and we're actually going to be picking this up at episode number 22, getting into the, shall we say, non-QM or non-conventional space. Any last, shall we say, tips or tricks that you want to get to my listeners that are looking at and qualifying for their first, second, or maybe 10th investment property?
Yeah, I would say the relationship with your lender obviously is just as important as your turnkey and your educator about real estate investing, your property manager. All of those relationships are very important, and selecting someone that you can trust to guide you and support the end goal. I would say, so John, Ridge just started a new community, online community. I have another live event coming up next week. I don't know if you want me to touch on that, but in that particular live event, we're going to be talking about Schedule E and the calculation of rental income as it applies.
Oh, okay.
So we're trying to get the word out to those that may have some interest in learning how to do this, because tax time is around the corner.
Yep.
This year is going to be important. That would be one that they want to tune in for.
Okay, sounds good. Yeah, I will definitely. I just signed up for the community, I think last week, if I remember right. Cool. So I'll make sure to mention that in the show notes as well. And I'm just going to throw one little tidbit, and this is what I run into as a, investor and an agent as well, where I help, investors get their next investment property, or even home buyers. When you're going through this whole process and Caeli gives you the, 2 thumbs up, says, hey, you're qualified, everything's looking good. Don't quit your job. Don't get a new car loan. Don't rack up the credit cards. Don't go on a new trip. Don't have a huge major expense. Just because you're pre-approved now, you want to make sure that stays that way until all the I's are dotted, T's are crossed. Once you have that in hand, then go wild and crazy, get that new car, get the fancy vacation, whatever, but please do not do that during the pre-approval process.
Or check with us first, right? Say, hey, exactly. I want to buy a new car. I want to make this purchase, and maybe it's fine, but if you do it before we know, it could really unravel the whole thing, and poof. Yeah. Quick little story. I had to laugh. I was doing a continuing education about 3 months ago. Guy was telling me about a homeowner was at the closing table, had everything signed, got up, walked away. Wow. What a great week. I got a new house and I got a new pickup. They're like, wait, what? Oh, and no.
Completely blew up the loan. I don't remember what the numbers were, but yeah, it just, right at the closing table. So again, just word of the wise, don't do anything detrimental that could smash your chances of getting your primary home or your next investment property.
Good point. Good tip.
Yeah. So, all right. Well, thank you again for joining us, Caeli. And this concludes episode number 20 of the Wealth and Freedom Nexus podcast. And be sure to join us here at episode 22, where we're going to do a deep dive into non-conventional financing, which can be a whole nother rabbit hole to go down.
Thank you for listening. Be sure to share, rate, review, and subscribe on your favorite podcast platform. For more updates, check out www.wealthandfreedomnexus.com. Remember, nothing on this show should be considered tax, legal, investment, or professional advice. This show is produced solely for educational and informational purposes. Please consult an appropriate and licensed tax, legal, real estate, or business professional for specific advice for your situation. For distribution or publication rights or media interviews, please contact the host.